Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing enterprise product stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Enterprise owns, transports, and stores crude oil and natural gas. To put it simply, it makes money by storing and moving energy through its pipeline to various customers. The company is headquartered in Houston, Texas, and was founded in 1968. The ticker trades on the New York Stock Exchange, Mexican Bolsa, Sao Paulo, and London Stock Exchange. Let's get started with the model. This is a large cap company, 53 billion market cap. They're trading at $24 a share, and they have 2.2 billion shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Their free cash flow grows a lot from 2 billion up to 6.7 billion. Net income is the profit or loss on the income statement. It's revenue minus expenses. And that's pretty steady, 4.7 billion in 2019 and 4.7 billion in the trailing 12 months. Revenue is the sales for the company, and that grows a lot from 33 billion to 45 billion. It was low in 2020 due to low oil prices, but it came back up in 2021. As you know, oil prices are getting high, and they're even higher in 2022. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. Revenue minus cost of revenue gives you your gross profit. And they do have the same gross profit in the trailing 12 months compared to 2019. But their revenue is a lot higher in the trailing 12 months. So their margins are getting worse. They're converting a smaller percent of their revenue into gross profit when you compare it to 2019. Below that is their operating expenses. These are all the expenses not directly related to generating the revenue. Those are really small compared to their cost of revenue. Gross profit minus operating expenses gives you your operating income. It's almost identical when you compare 2019 to the trailing 12 months. But once again, their revenue is a lot higher in the trailing 12 months, so their margins are much worse. They spent 1.3 billion of interest on their debt, which is pretty similar to the last 3 years. Then you have other income and expenses. These are all the gains or losses not part of the company's core operations. Your pre-tax income, your taxes, and the bottom line of the income statement is your net income. And there are MLP, Master Limited Partnership. MLPs pay very little in taxes. That's why their taxes are so low relative to their pre-tax income. The reason they're able to pay such low taxes is because they have to pass on at least 90% of their profits back to their investors in the form of a dividend. So they have pretty solid net income each year. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. They generated the most cash flow in the trailing 12 months, 8.6 billion, a lot higher than 2019 and 2020. They invest a lot in CapEx, 1.9 billion in the trailing 12 months. It was high in 2019, 4.5 billion, and 3.3 billion in 2020. Operating cash flow minus CapEx gives you your free cash flow. And they do have a lot of free cash flow, so they do pay a nice dividend. Since MLP and REITs tend to pay a really big dividends, there's not much money left over to grow the business, so they tend to take on a lot of debt. They added 17 billion of debt in the trailing 12 months, paid down 16 billion. They added 58 billion of debt in 2019, paid down 57 billion. Let's look at the capital structure. 26 billion of equity, 30 billion of debt. They're 46% equity, 54% debt. Their net debt is 29.3 billion, and their WACC on Finbox ranges from 7.8% to 9.3%. I gave them the highest of 9.3%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated the terminal value, which is all cash flows, past year 4, that's 70 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $68 billion. We divide that by 2.2 billion shares, and we get a calculated stock price of $31. They're trading at $24, so they're trading at a 23% discount. It's a buy according to the model. Their revenue target for 2024 is 49 billion. For 2023, it's 50 billion, and for 2022, it's 49 billion. I continued this trend into 2025 and I got 47 billion. That's how I got their future revenue estimates. They convert on average 12% of their revenue into free cash flow, so I multiplied their future revenue estimates by 12%. That's how I got their future free cash flows. The website Simply Wall Street values the company at $34. They're saying it's 29.6% undervalued. 13 analysts priced this stock and the average price target is 31. The low is 29, the high is 33. This is where the stock has been trading the last 5 years. Before COVID, it was over $30 a share. Then it dropped to about $11 at its low point. It has come up a lot since that point, up to about $28. But it did drop a bit in the past couple of weeks like most stocks have. It's still trading at a decent discount relative to its pre-COVID highs. In the past 5 years, Brent crude is up 143%. This stock and the midstream ETF ENFR are down about 11%. All three investments were pretty close to each other for about 3 years, but Brent crude has taken off, while the midstream stocks and this ETF are pretty flat, up a little bit. If you want to invest in the ETF ENFR, these are the biggest holdings. Enbridge is the biggest, about 10%. Then the company we're looking at, 8.3%. Then TC Energy, Energy Transfer, Williams Companies, Pembina, Kinder Morgan, Targa Resources, Cheniere, and Plains. They raise their dividend a little each year. It was 42 cents in 2017, up to 47 cents. They pay a really high yield, 7.7%, which they can definitely afford. It's only 60% of their free cash flow, 86% of their net income. They've always paid a high yield, over 10% in 2020, and the forecast is for the yield to be over 8% by 2024. The last time they did a stock split was 8 years ago in 2014 at 2-for-1. Before that, it was 20 years ago in 2002, another 2-for-1. They have a beta of 1.12, so the stock is a little more volatile than the market. It's gone up 2% in the past 52 weeks, while the S&P is down 9%. The 52-week low is 20, the high is 29. And the stock is trading slightly above its 200-day, but below its 50-day moving average. 9 million shares are traded each day on this stock. Of the 2.2 billion shares outstanding, 1.4 billion are on float, 28% are held by institutions, and 1.5% of the shares are shorted. If you invested $10,000 into this company 10 years ago, you'd have $18,000 today. That's a 78% return, a 6% annual return. The CEO's annual salary is $1 million, and their total compensation is $10.4 million. It was a bit lower in 2016, 17, and 18, but then it jumped up in 2019. In the past 12 months, there's been only insider buying, no selling. All the buys are fairly close to where the stock is trading at right now. Some of the buys are above the current trading price, but I guess a lot of the insiders are bullish on this company, which is a good sign. 40% of the companies held by the general public, 34% by private companies, 25% by institutions, and 1.4% by insiders. The biggest shareholder owns 31%. I think this is the family trust of the Duncan family. Dan Duncan is the founder of the company. His daughter right here owns 1% of the stock. BlackRock and Blackstone both own over 1%, and a bunch of other shareholders. Let's look at their financial ratios. They have a really good PE of 11. That's stock price over earnings per share. That means investors are paying $11 for $1 of earnings. Price to sales of 1.2, price to book of 2.1, and a good price to free cash flow of 7.8. That's stock price over free cash flow per share. Their return on invested capital is 8%. They can cover their interest payments 4.5 times, an ROE of 19%, and they can cover 80% of their current liabilities with their current assets, a quick ratio of 0.7. They generated $6.7 billion of free cash flow in the trailing 12 months. They have negative $2.4 billion of working capital, and they pay out $4 billion of dividend payments. So it is possible they may need to add some debt to get through the next 12 months. The best way to look at ratios is to compare them to companies in the same industry. Enterprise has a better ratio than the average in all the categories. They spend more than average in CapEx. They have a better debt to equity ratio. They pay a really high dividend. but the dividends you receive on an MLP or REIT get taxed at a higher tax rate. So you have to take that into account. If a regular stock, a non-MLP, paid a 7% dividend, you might be better off taking that 7% dividend than this one, even though it pays more. They generate more free cash flow than any company in this industry. They rank second in market cap. Enbridge is the only company that's bigger. All their price multiples are better than average. They generate more revenue than pretty much any company. It looks like Plains generates the most. Their 5-year revenue growth rate is 12% higher than average, and their ROA and ROE are higher than average. So to summarize, I have them trading at a 23% discount, and I think most people own this stock for the big dividend payment. And especially in the past year or so, that strategy has worked out well. They've been paying their high dividend, the stock has been going up. As long as those two things occur, investors are happy. Plus, the oil and gas industry is super hot right now. The price of oil is going through the roof, and it doesn't seem like demand is even close to waning. I ranked their free cash flows 8 out of 10, their revenue 8 out of 10, and their ratios 9 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.